Today, I'm diving into the field of finance, but with a twist. The topic is going to be behavioral finance, a discipline that combines both psychology and economics to help us better understand how human behavior influences financial decisions. In this video, I plan to touch on the key concepts of behavioral finance and explore how our biases and emotions impact our financial choices. So let's get started. Simply put, behavioral finance recognizes that humans are not always rational when they make financial decisions. Shocker, right? Who would have thought that would have been the case? Where traditional finance theories assume that individuals are always rational and always make decisions that are in their best interest. Even I will admit that I tend to behave this way when I engage with certain people who come to me looking for assistance in putting a strategy together to tackle a certain challenge that they're having. Some examples would include things like making a budget, creating a savings plan, and potentially even discussing what their interest rate should be and the structure of their loan to best optimize their current situation. I used to present a solution with a very straightforward or black and white approach, which very rarely stuck. And since then, I've learned it's not always as simple as following a very clear-cut set of instructions. Lots of other things play into the mix, especially when the people that I'm talking to about these topics have not yet established the habits that they need to establish in order to perform this consistently over a long period of time to get the results that they actually want. So bringing awareness to the topic of behavioral finance as a whole, it really helps when we have an understanding that, hey, I might not be thinking clearly here. My biases and emotions and my cognitive inability to make rational decisions at this very time may not all be there, which gives me a little bit of an edge to understand ways that I can actually approach solving a problem and be wary that some of these things may influence my financial decisions. Another way to think about it as well is that it often plays into people's justifications for their reasoning for why they have deviated away from a specific goal, challenge, or plan that they've put together in order to reach that goal, that end game. It generally plays into this again. Why are they making financial decisions that aren't in line with that plan? And this is where behavioral finance as a whole comes into play. With that being said, let's take a look at some cognitive biases that affect people's decision making. One example is known as the anchoring bias, where people rely way too heavily on the initial set of information that they've been fed when setting out to achieve whatever it is they've set out to achieve. This bias can lead to irrational valuations as well as skewed perception of what financial opportunities can actually create for them. As an example, imagine you're shopping for a new laptop, and let's say you go to a store and you find a high-end model, like top tier model, for $2,000. You then go off to another store to see what the competition looks like and find a medium or mid-level range laptop for about $1,200. The anchor bias comes into play here because your mind may still be focused on that $2,000 price tag. So your perception of something that's expensive means that even at this $1,200 price point, if it's a good deal, your decision making may be hindered or affected because you're anchored to that original $2,000 price mark. It's the type of thing that might make someone hesitate to make a purchase if it's a good time, a good deal, and fits what they need to actually buy, as well as it might make them continue their journey and add additional work when the solution was right in front of them all along. It's an interesting one because hunting for a better deal and waiting before making purchases is all well and good, but in this instance, if you've done the research and you understand what you need and the right thing is sitting in front of you, sometimes you should pull the trigger. This I see happen quite a lot with property, and I've seen it happen quite a lot in my very short time in the industry, but it's actually fascinating to hear and see an example that you can kind of relate to that absolutely has this bias in mind. Another common one is the confirmation bias, where people seek and interpret information that confirms their pre-existing beliefs, while ignoring and dismissing contradictory advice. This one in particular can lead to some very poor financial decision making. As an example, let's say that you have a very strong belief that investing in a particular tech company will result in significant financial returns. Whenever you come across things like YouTube videos, news articles that highlights positive development for that company or product, it makes you reinforce in your brain even more that this product is going to do well and successful, and it adds to the confirmation of your original belief. People who fall into this trap as well also will seek out advice and opinions from people who share those exact beliefs, further adding to the overall bubble, we'll call it, of the confirmation bias. However, people trapped within this bubble may choose to downplay or even outright ignore things like warning signs, critical analysis, as well as negative news that all may raise legitimate concerns about this product or company's financial health, as well as their long-term viability. In this case, confirmation bias leads you to selectively favor as well as accept information that aligns with your pre-existing belief about this company or product's potential, which can be really bad in the world of making financial decisions that aren't calculated. Additionally, we have the availability bias, which occurs when individuals make financial decisions based on readily available data instead of looking at the full scope of information that may be out there. This bias can lead to overemphasizing recent events or media headlines and instead ignore long-term trends and historical data. The example in this instance would be, let's say you're thinking about investing your money into the share market and you have found a news article which has told this story about the success of an individual who chose a very specific stock and put their money into it and made a heap of money from it. This success story becomes easily accessible in your mind and it creates a strong impression on you. As a result, you may become more inclined to invest in a specific stock or company that aligns with what the outcome of this success story was. However, you might overlook or underestimate the risks involved or the key pieces of information that led to this person's huge success, where in turn your results may not be the same and the outcome may not be the same, and you actually made a very poor financial decision to invest in this thing. Overall, for these three in particular, bias plays a really strong part of our decision-making process. And if we can remove bias and look at the facts and information readily available to us, as well as understanding the history of those types of investments, just to draw back on the examples I talked on a moment ago, our decision-making should overall improve and not be as affected by our behavioral finance as an overall topic, label, however you want to say it. It is the thing that we need to be conscious of when making these decisions. Which kind of leads me into our emotions, which also play a significant role in our decision-making process. I am sure that you have heard the term FOMO, which is the fear of missing out for those who don't know. It is something that is used as a tool to make others very, very wealthy. Simplest example possible is that during market downturns, the fear of missing out, or just fear in general, can put people in an implicated situation where they might choose to sell their investments for a loss. They might break even, or they might even make some profits on it, with the outcome never being looked at long-term perspective. Another really good example of how FOMO has taken place within Australia over the COVID-19 pandemic, we have seen lots of people enter the market at really crazy prices for property. Prices we've never seen ever before. Even where I live here in South Australia, it has been pretty wild, where people may have over leveraged or extended themselves in a way that is definitely playing a pretty harsh game on them right now. It's probably taking a toll with what has occurred with interest rates over the past year and a half, where these decisions are actually starting to have adverse consequences, where I'm noticing more and more people posting every single day on forums that talk about finance directly, about their struggles to make their minimum repayments, as well as people within kind of my own friends group and others that I know as extended friends who are really struggling to come up with the cash to even pay their mortgages as the cost of living has risen, along with the debts that they need to continue servicing. It is a concern for a lot of people, and it's something that definitely emotions played a big role in over that period of time. Now, in the opposite direction, greed can also lead to excessive risk taking, where individuals become overly optimistic about the returns that they can potentially make. People engage in speculative investments all the time. They also often ignore common and important risk management practices, ultimately exposing themselves to unnecessary financial risks. I said it at the very start of the video and I'm going to say it again now. Behavioral finance recognizes that understanding and managing our emotions plays a crucial role in making sound financial decisions. By being aware of our own emotional biases, as well as taking steps to mitigate the influences that they have on our decision-making process, overall, we should be able to make better and more informed decisions which benefit us long term. It really worries me because behavioral finance as a whole really plays a part in almost every aspect and field within finance. Investing is just one very simple example that I can draw many examples from. Diversifying our portfolios, setting long-term goals, and doing our research before jumping into anything are probably the three best strategies and tactics that we should be using almost with every decision we think about making, separate to finance in general. It is a really good way to go about making sure that you are taking a calculated risk rather than a speculative risk, to keep it simple. Personally, I discuss these topics on my channel, in my videos, pretty much all the time. They are things that I have lived by for a really long period of time. I am a very black and white person when it comes to my finances. There are a set of rules that I follow that have served me incredibly well. It's not rocket science. It's not something that's even that hard to learn. It just takes time, consistency, and a bit of practice. Every now and then, a little bit of sacrifice. But like I said, overall, it really is worth understanding. If you've made it this far into the video and you've actually taken something from it, I'm really glad, because this is the type of stuff that really changes people's mindsets to kind of put them in a place that will help them long term. To wrap up, make sure that you embrace the insights offered by understanding behavioral finance as a whole. It will help you make more informed financial decisions to help you build a more secure future. And that is pretty much all I wanted to cover in today's video. So if you learned something, if it was insightful, hit that like and subscribe button down below, or just do it anyway. I really appreciate the support and it definitely goes a long way for the channel. So thank you if you did take the time out of your day to quickly do that, and I'll leave you there. So have a good day, have a good week. And as always, I will see you in the next one. Bye for now.